All right. Hello, everyone. I'm Aaron Sachs. I'm a senior manager in our Hillsborough office and a leader on our nonprofit team. I want to welcome you to our presentation today, Governance and Financial Oversight Essentials for Board Members. Today, I'll be presenting with fellow members of our nonprofit group, Carrie Young and Tyler Weber, and we'll go over all things board service. We'll be walking through everything from fiduciary duties and responsibilities to best practices for improving board engagement and retention. First, I'd like to share who we are at Jones & Roth. Our firm has been serving clients in the Pacific Northwest for more than 80 years. We proudly are an independent CPA firm. We have 3 offices across Oregon with a team of about 100, and we are invested in our communities where we work and we live. Our team is niche focused and allows us to specialize in industries to serve our clients with the technical expertise of a large firm while providing the quality service you expect of a local firm. Our nonprofit group is one of the largest in the firm. We have a diverse team of CPAs and business advisors dedicated to serving our nonprofit clients. Now to introduce my fellow presenters today, Carrie, we'll start with you.
Hi, everybody. Good afternoon. It's just afternoon right now. I'm glad to be here with you today. My name is Carrie Young. I'm a partner in our Eugene office, and I help lead our nonprofit and affordable housing niches.
And I'm Tyler Weber. I'm a senior manager up in the Hillsborough office, and I am part of the nonprofit and affordable housing niches as well.
All right. Well, thank you, Carrie and Tyler. Let's take a look at our agenda. So we'll be discussing the purpose and scope of board governance, why boards exist, the critical role that members play in guiding the organization. And then next, we'll be diving into fiduciary duties and responsibilities of board members, the key legal, organizational, and ethical requirements and expectations that come with board service. We'll then cover stewardship considerations, the critical role boards serve in connecting the organization with the community. And finally, we'll discuss board composition, engagement, and structure, identifying best practices and some common pitfalls that you'll want to avoid. If you have any questions, please feel free to reach out to us after the webinar. We're always happy to help. All right, we'll begin with understanding the purpose and scope of nonprofit board service to lay the groundwork for the rest of the content that we'll be covering today. So Peter Drucker, the late management consultant, educator, and author, captures the concept of board service especially well in this quote. Board membership means responsibility not just to the organization, but to the board itself, the staff, and to the institution's mission. So it's not just a symbolic position, but instead an active commitment to mission, governance, accountability, and organizational success. Effective nonprofits require a strong board that serves as a guardian to the organization's mission and works in partnership with management. Board governance in nonprofit organizations exists to ensure that the organization remains legally compliant, mission-driven, and accountable to public trust. Unlike for-profit boards, nonprofit boards do not represent shareholders seeking financial return. Instead, they steward charitable assets for the benefit of the community and the organization's stated mission. This governance role sets the tone for ethical behavior, transparency, and long-term sustainability. A well-functioning board clarifies why the organization exists, whom it serves, and how success is measured over time. The scope of board governance typically includes setting strategic direction, establishing policies, and providing oversight rather than managing day-to-day operations. While staff and volunteers handle implementation, the board, on the other hand, is responsible for ensuring that activities align with the mission and comply with legal and regulatory requirements. For example, boards typically are very involved in goal setting and strategic planning and monitoring progress towards goals and implementing a strategic plan. Boards are also tasked with ensuring resources are used appropriately. This separation between governance and management helps prevent micromanagement while maintaining accountability. Another critical aspect of board governance is accountability to the multiple stakeholders, and that includes donors, beneficiaries, regulators, and the broader community. Board members act as trustees of the organization's reputation and credibility. Their decisions influence public confidence, fundraising effectiveness, and partnerships. When governance is weak, nonprofits face increased risks such as financial mismanagement, mission drift, and even loss of tax exempt status in some extreme cases. Effective governance also provides continuity and institutional memory. Board members often serve staggered terms, allowing knowledge and expert experience to carry forward, even as staff or leadership change over time. Through policies, documented decisions, and consistent oversight practices, the board can ensure that the organization remains stable and resilient. Ultimately, strong nonprofit board governance is about balancing responsibility, foresight, and stewardship to protect the organization's mission today while positioning it for future impact as well. One of the primary reasons nonprofits are required to have boards is legal accountability. State and federal laws mandate that nonprofit corporations be governed by a board of directors responsible for compliance with statutes, regulations, and reporting requirements. This includes maintaining tax exempt status, filing annual reports, it's the Form 990, and adhering to charitable solicitation laws. Without an active and informed board, organizations risk penalties, loss of exemption, or legal action. Fiduciary responsibility is another core reason for board existence. Board members are entrusted with safeguarding the organization's assets and ensuring they're used exclusively to further the charitable mission. This fiduciary role encompasses oversight of finances, property, intellectual assets, and reputation. For example, boards approve budgets, monitor financial statements, and ensure adequate internal controls are in place to prevent fraud or misuse of funds. Stewardship extends beyond compliance and finances to include protection of public trust. Nonprofits benefit from public confidence, donor generosity, and volunteer engagement, all of which depend on ethical governance. Board members demonstrate stewardship by acting with integrity, transparency, and accountability, reinforcing the organization's credibility. This is particularly important because nonprofit financial information, executive compensation, and governance practices are often publicly accessible via the Form 990. Finally, boards provide strategic and organizational stewardship by keeping the organization focused on its mission. They help prevent mission drift by evaluating programs and initiatives against the stated goals and the needs of the community. By asking thoughtful questions and challenging assumptions of the past, boards add value beyond operational management. In this way, the board serves as both the guardian and the guide, ensuring that the nonprofit remains legally sound, ethically grounded, and mission focused over the long term. All right, next we will be discussing the duties and responsibilities entrusted to board members. Tyler, I'll go ahead and turn it over to you.
Right, thank you, Aaron. So now to kick off this section, let's first outline the three fundamental duties of trust the nonprofit board members are bound by. These include the duty of care, the duty of loyalty to the organization, and the duty of obedience to the law. Together, these duties define the legal and ethical standards by which board members must govern. Understanding and applying these duties is essential for effective governance and risk management. Now let's explore each of these duties a little bit deeper. Under the duty of care, board members must act with informed judgment and reasonable diligence while actively participating in meetings and decision-making. Active participation is one of the most critical expectations. Board members must actively participate in the management of the organization, including regularly attending meetings, evaluating reports, reading minutes for consistency, and reviewing the performance of the executive director. Board members are also expected to contribute thoughtfully to discussions. Another key responsibility is reasonable inquiry. Board members should request and receive sufficient information in order to carry out their responsibilities as board members and to make sound decisions. If reports indicate potential problems, such as financial irregularities or operational risks, board members have a duty to investigate those further. This does not mean conducting day-to-day management. However, it does require understanding the organization well enough to recognize any red flags that may pop up. The duty of loyalty obligates board members to put the interests of the nonprofit above personal or professional interests. Decisions must be made solely for the benefit of the organization without conflicts of interest. When conflicts do arise, they must be disclosed and managed accordingly to the established policies. This duty reinforces public trust by ensuring the board actions are free from self-dealing or favoritism. Conflicts of interest arise when board members' personal, financial, or professional interests could influence or appear to influence their decision-making on behalf of the nonprofit. While transactions involving board members are not automatically prohibited, they should be approached with caution and appropriate safeguards should be in place. Best practices is for board members to disclose any potential or actual conflicts, refrain from participating in discussions or votes related to the matters, and ensuring the organization documents its decision-making process. A written conflict of interest policy helps promote transparency and protects both the organization and its board members when conflicts of interest arise. So here's an example of a potential conflict of interest situation. A board member owns a marketing company, and the nonprofit for which they sit on the board of is seeking proposals for a new website and fundraising campaign. The board member's company submits a bid to the nonprofit for the work. This situation creates a conflict of interest because the board member could personally benefit financially if the nonprofit awards the contract to their company. Additionally, loans to board members are generally prohibited and, in many situations, may raise significant legal and regulatory concerns. Providing loans to directors can create divided loyalties and undermine public confidence in the organization's stewardship of their charitable assets. Board members should avoid situations where they receive personal financial benefit from the nonprofit, and organizations should have policies in place to prevent these arrangements from occurring. Lastly, the corporate opportunity doctrine requires board members to act in the best interests of the nonprofit when opportunities related to the organization's mission, activities, or assets arise. A board member may not appropriate an opportunity for personal gain if the opportunity properly belongs to the organization. For example, if a board member learns of a funding source, partnership, property acquisition, or other business opportunity through their board service, that opportunity should first be presented to the nonprofit. This principle reinforces the duty of loyalty by ensuring that board members do not use their position to benefit themselves at the organization's expense. And the final piece of the duties of trust is the duty of obedience. The duty of obedience requires board members to ensure that the organization complies with applicable laws and adheres to its own mission and governing documents. This includes following the articles of incorporation, bylaws, and stated charitable purpose. Together, the duties of care, loyalty, and obedience form the backbone of responsible nonprofit governance and guide board members in fulfilling their roles effectively. In addition to the 3 duties of trust, board members take on many additional duties and responsibilities, one of the most important being providing financial oversight for the organization. Board members are charged with ensuring that the organization has adequate accounting systems, internal controls, and financial policies in place. This oversight protects charitable assets and supports informed decision-making. Key financial responsibilities include approving the annual budget and oftentimes helping craft the annual budget, timely review of financial statements, and monitoring performance against budgeted expectations. This includes asking questions if there are items that are not making sense, such as large budget to actual variances. And financial reports such as balance sheets, income statements, and budget to actual comparisons should be provided in advance of meetings to allow board members adequate time to review before having open discussions at the meetings with fellow board members. Board members may also be responsible for hiring an independent auditor if the nonprofit requires an audit and reviewing audit findings at the board level. Internal controls are particularly important in the nonprofit sector where fraud risks are on the rise. Boards should ensure that duties are appropriately segregated, expenditures are being reviewed, and large or unusual transactions receive additional scrutiny. In some cases, boards may even be directly involved as check signers or reviewers, especially in smaller organizations where proper segregation of duties is more difficult to achieve. Effective financial oversight goes beyond compliance to include strategic stewardship of resources. Boards establish policies related to investments, asset purchases or sales, and acceptance of non-cash donations, such as equipment or property. By maintaining a strong financial governance framework, boards help ensure sustainability, transparency, and trust. Some additional board responsibilities with respect to the organization include regular review of governing documents, compliance, assessing risks to the organization, and record keeping. Strong governance begins with clear, current, and well-maintained governing documents. These include the Articles of Incorporation, bylaws, and formal board resolutions. Together, these documents define the organization's legal existence, governance structure, and operating procedures. Board members are responsible for understanding these documents and ensuring that the organization follows them consistently. Periodic review of governing documents helps ensure that they remain aligned with the organization's mission and current operations. As nonprofits evolve, outdated bylaws or policies can create confusion or risk for the organization. By building regular review into the governance cycle, boards promote clarity, compliance, and organizational resilience. Board members also have responsibilities with respect to compliance. Compliance responsibilities extend to both federal and state requirements, as well as compliance with grant terms, loan agreements, and other binding contracts. Nonprofits must apply for and maintain tax-exempt status with the Internal Revenue Service, file annual information returns, and comply with state registrations and reporting obligations. Certain fundraising activities, such as raffles or bingo, may require additional licenses in order to be in compliance with state or local laws and regulations. Board members play a critical role in overseeing these obligations and confirming that filings are accurate and timely to mitigate risks to the nonprofit's exempt status. Another oversight responsibility is to assess risks to the organization. Boards should regularly evaluate the internal and external risks that could affect the organization's ability to fulfill its mission. These risks may include financial challenges, cybersecurity threats, regulatory changes, reputational concerns, operational disruptions, or the loss of key personnel. One common tool used in assessing risks is a SWOT analysis, which helps identify the organization's strengths, weaknesses, opportunities, and threats. By periodically assessing risks and discussing mitigating strategies, board members can make more informed decisions, allocate resources effectively, and improve organizational resilience. Risk assessment should not be viewed solely as a compliance exercise. It is also a strategic process that helps the organization anticipate challenges and capitalize on opportunities before they arise. Additionally, board members should ensure there is proper record keeping. Boards must ensure that minutes, records of actions taken, and committee reports are properly documented and retained. These records provide legal protection, demonstrate accountability, and preserve institutional memory. They are often the first materials reviewed during audits, investigations, or leadership transitions. One of the challenges for some organizations is clearly delineating roles and responsibilities of the board versus those of management. When it comes to strategy, the board helps define the mission and strategy, while its management's job is to execute that strategy. Similarly, when it comes to policies, the board may help set the policies and likely approve significant ones, but it's management's job to implement the policies and make sure they are being followed. The board helps monitor the performance of the organization as a whole, but it may or may not make sense to have the board looking at data on a more granular level, such as programs. Typically, the board hires and completes performance evaluations for the CEO or executive director and perhaps other high-level management staff. However, it is the job of management to oversee the staff under them. The board oversees finances and overall risks, but should not be in the details of the daily operations. Generally, the board should review key performance indicators, monitor organizational effectiveness, ensure adequate staffing and resources exist for the nonprofit, oversee major risks and compliance matters, and approve any significant organizational changes. Alternatively, the board should generally avoid directing staff, making operational decisions, getting involved in personnel matters below the CEO level, managing vendors or contractors, and running programs or departments. This is often described as board members staying out of the weeds. The board's sweet spot is stewardship without management. The most effective board members ask questions such as, are operations aligned with the mission? Is management effectively executing the strategic plan? And does our fundraising strategy support long-term sustainability for the organization? Okay, so I'm now going to turn it over to Carrie to further our discussion on donor stewardship.
Thanks, Tyler. Donor stewardship is a critical governance responsibility because it directly affects trust, reputation, and long-term relationships in the community. Board members should serve as ambassadors. That means that they should promote the organization's mission and programs within the community. They should also help build awareness and credibility of the organization, its missions, and its programs. Additionally, board members should connect prospective donors, foundations, and business partners with the organization's leadership and/or fundraising team. Donors are also appreciate when board members thank them and send thank you and recognition letters for contributions. Typically, board members are also expected to participate in fundraising activities. They should assist with donor cultivation and relationship building by being a connection maker. Board members should also attend and/or volunteer at fundraising events and may attend donor meetings when appropriate. Typically, there is also some expectation that board members will make personal gifts to the organization when they are able to do so. Board members also serve an important role in protecting public trust. This includes ensuring transparency regarding finances and impact in the community. This includes review of publicly available documents, including the Form 990, and for many organizations, the audited financial statements. This also includes supporting accurate and honest communication with donors and reviewing whether the organization is delivering on promises made. Generally, board members should not manage fundraising staff, approve routine donor communications, direct day-to-day development activities, or maintain exclusive ownership of donor relationships. These responsibilities belong to management and development staff. The sweet spot for a board member is asking bigger picture questions, such as, does our fundraising strategy support our sustainability? Are donor funds being used appropriately? And are we retaining good relationships with donors? You shouldn't be asking, which donor should we call next? How should a fundraising letter be written? Or which employee should contact which donors? Boards should oversee responsible solicitation practices. This means ensuring donations primarily support programs with oversight on fundraising costs and ethical compliance. Let's review some policies that support this. The first is a gift acceptance policy. A gift acceptance policy establishes what types of donations the organization will accept and under what conditions. A clear gift acceptance policy and donor restriction policy help organizations manage this responsibility effectively. Boards may define what types of restrictions are acceptable and establish thresholds for naming opportunities or location-specific gifts. These policies protect the organization from accepting gifts that create undue administrative burden or conflict with strategic priorities. Key provisions of a gift acceptance policy include the types of gifts accepted, including cash, securities, real estate, whether cryptocurrency will be accepted, etc. It also indicates what types of gifts require prior board approval, procedures for valuing non-cash gifts, and circumstances in which gifts may be declined. This policy also addresses treatment of restricted versus unrestricted gifts. And it can also include review of gifts that create reputational, legal, or financial risk. Why this matters is because it protects the organization from accepting gifts that create excessive obligations or risks and ensures consistency in donor treatment. Another related policy is a donor restricted funds policy. Restricted donations are often an area of audit and/or donor scrutiny, so having a policy to address this is best practice. Key provisions of a donor restricted policy include capturing and documentation of donor restrictions, how you will account for the restrictions and releases thereof, the process for approval of expenditures and releases of donor restrictions, how any restrictions will be reported to donors, and procedures for handling obsolete or impractical restrictions. This ensures gifts are used according to donor intent and reduces legal and financial risk to the organization. Another important policy is a donor recognition policy. This policy outlines how donors will be thanked, acknowledged, and informed about the impact of their gifts. Key provisions of this policy include how you will make timely acknowledgement of contributions, general donor recognition practices, how you may report to major donors and grantors, how you will ensure compliance with donor restrictions, procedures for correcting stewardship errors, and also donor privacy options. This encourages donor retention and demonstrates accountability and transparency. We also suggest having a donor privacy and confidentiality policy. Organizations collect sensitive donor information and should clearly define how that information is protected. This is more and more important every day with various cyber, phishing, and other fraud schemes that exist. Key provisions of this policy include protection of donor records, access limitations for staff and board members, prohibition on selling or sharing donor lists, data security standards, compliance with applicable privacy laws, and procedures for donor requests regarding any personal information. This is very important because it protects donor interest and reduces cybersecurity and other risks to the entity. Some additional policies that are best practices include having a fundraising ethics policy. This policy establishes ethical standards for fundraising activities, ensuring truthful and accurate solicitation materials. and compliance with fundraising regulations. Additionally, having a conflict of interest policy is very important, as we previously discussed. With respect to fundraising activities can create perceived or actual conflicts of interest, so having this policy in place is important. It's also a good idea to have a board fundraising expectations policy. Many nonprofits struggle because fundraising expectations for board members are unclear. Key provisions of such a policy include the board members' role as ambassadors, participation expectations, personal giving expectations, if any, and donor cultivation responsibilities. Lastly, we recommend you consider implementing a whistleblower policy. Fundraising and donor stewardship involves handling funds, donor assets, and it's important to have this policy as a fraud deterrent. Key provisions of a whistleblower policy include what reporting mechanisms exist, confidentiality protections against somebody using the whistleblower policy, anti-retaliation provisions, and what the investigation procedures are. This is important because it supports ethical conduct and helps identify problems early. By overseeing donor stewardship thoughtfully, boards reinforce accountability and transparency. This stewardship strengthens donor relationships, supports sustainable fundraising, and upholds the organization's commitment to using resources ethically and effectively. I'm now going to turn it back to Aaron to discuss board structure and board engagement.
Thank you, Carrie. And certainly can't be overstated enough how important those policies are, especially for continuing a strong board performance. So, all right, we're going to go over structure. All right, so board governance best practices. Effective governance does not happen by accident. It requires intentional practices that help boards fulfill their fiduciary responsibilities and provide meaningful oversight. While every organization is unique, there are several governance practices that consistently contribute to board effectiveness and organizational success. Bylaws and other policies. A strong governance framework begins with clear and well-documented policies. Bylaws establish the rules for how the board operates, while governance policies provide guidance on issues such as conflict of interest, document retention, whistleblower protections, and board responsibilities. These documents should be reviewed periodically to ensure they remain current, legally compliant, and align with the organization's mission and operations. All right, let's talk about meetings. So regular board meetings are essential for effective oversight and informed decision-making. Meetings provide an opportunity to review financial performance, monitor organizational activities, address strategic issues, and fulfill fiduciary duties. Accurate meeting minutes should be maintained to document discussions, decisions, and actions taken by the board. Good documentation demonstrates accountability and creates an important historical record. And certainly with all the AI tools out there now, it's easier than ever to have those board minutes taken with little to no effort. Just be careful about what you're using for that purpose. All right, self-assessments. So high-performing boards periodically evaluate their own effectiveness. Self-assessments help identify strengths, areas for improvement, gaps in expertise, and opportunities to enhance board performance. These assessments can examine topics such as meeting effectiveness, strategic oversight, committee performance, and board engagement. A commitment to continuous improvement helps ensure that boards remain effective as the organization evolves over time. All right, diverse and qualified members also really important. An effective board benefits from a variety of perspectives, experiences, and skills. Recruiting board members with diverse backgrounds and professional expertise strengthens decision-making and allows board members to better understand and serve the community. Committee structure. So committees allow boards to focus attention on key areas of responsibility in greater depth. Common committees include finance, audit, governance, and development committees. Effective committee structures help distribute work, leverage specialized expertise, and bring well-considered recommendations to the full board. Divide and conquer strategy. Committees should have clearly defined responsibilities and regularly report their activities to the board. Ongoing education is also really important. Board service comes with significant legal and fiduciary responsibilities. Ongoing education helps board members stay informed about governance best practices, regulatory requirements, financial oversight responsibilities, and emerging risks facing the organization. Orientation for new board members and continuing education for existing members promote informed decision making and strengthens the board's overall effectiveness. All right, let's discuss board composition. An effective nonprofit board is intentionally composed to reflect a balance of skills, perspectives, and backgrounds. Diversity in areas such as professional expertise, lived experience, age, gender, and community representation strengthens governance by broadening insight and reducing blind spots for the board as a whole. Board composition should align with the organization's mission, strategy, and stage of development. So it can certainly be dynamic over time. Recruitment. So recruitment should be treated as a deliberate process rather than just filling vacancies with willing volunteers. Similar to hiring staff, boards benefit from defining roles clearly, identifying desired competencies, and using interviews or behavioral questionnaires to assess if it's the right fit or not. Potential board members should understand expectations related to time, fundraising, and engagement before joining. In addition to skills and diversity, boards must be mindful of common challenges, such as overcommitted members or individuals with narrow agendas. Awareness of these dynamics helps boards maintain balance and effectiveness. A thoughtful onboarding process, including orientation and training, it further supports new members in contributing meaningfully. By investing in board composition and recruitment, nonprofits build a foundation for strong governance, accountability, and long-term success. All right, fit and alignment. Why does it matter? A study published by BoardSource found that 67% of nonprofit CEOs reported that boards spend insufficient time building relationships with the communities that they serve in. 49% of CEOs reported that they do not have the right board members to establish trust within the communities that are served. And only 32% of boards highly prioritize knowledge of the community served when recruiting directors. All really important things I think we'd agree on, right? But pretty surprising the results of this survey. So these findings suggest that many nonprofits struggle with board member fit, which is a known contributor to disengagement and turnover. Organizations require members with strong character traits in order to maintain an engaged, functioning board. One with shared values, understanding, tolerance, and respect. Finding board members can be difficult. It can be really tempting to just accept the first volunteers that say yes, but that's short-sighted. It's really important that organizations establish an interview process so that both parties can get to know each other and determine whether it's the right fit. So here's some soft skills that are critical to creating a functioning, productive board: commitment, common sense, humor, self-awareness, respect for group process, and probably most importantly of all, openness. So if you have these qualities in your board members, that's really going to serve you well over the long term, and really develop the culture that you want to see in your board. All right, in addition to the characteristic traits, organizations should also aim to construct a board where members contribute a balance of complementary skills. The type and size of the board help determine the required skill set of individual members. Certainly not every board is the same, And over time, the organization is going to change and the needs are going to change as well. To create and maintain a culture of accountability and management oversight, the boards must collectively have skills and abilities to operate in key functional areas. So that's not to say that you necessarily need a person that has a deep experience in each one of these areas, but certainly collectively as a board, you want to have at least a minimum in each of these areas that members can bring to the table and contribute. All right, sustaining an engaged board requires ongoing attention to motivation, clarity, and appreciation. Board members are more likely to remain active when their time is respected and their contributions are clearly connected to the organization's impact. Regularly reviewing the purpose of the board and highlighting program outcomes reinforces this connection. Engagement is also supported by using board members' expertise effectively. Involving members in committees, task forces, or special projects allows them to contribute in meaningful ways without overwhelming the full board. Recognition, both formal and informal, reinforces commitment morale. And certainly identifying what board members are going to be a strong suit for certain committees is a great way to utilize that effectiveness and really keep board members engaged. Board structure should align with the organization's needs and governance model. Committees such as finance, governance, and development allow deeper focus on critical areas while supporting effective decision making. Clear definitions of authority and accountability prevent confusion and duplication of effort. Finally, board members periodically assess their own performance and structure. As organizations evolve, governance needs to change. By remaining flexible and reflective, boards can adapt their structure and practices to continue providing effective oversight and strategic leadership. So really having an eye on what the long-term goals are of the board and having that as a backdrop for what types of board members you want to bring on is really an important thing to do. All right, let's talk about effective and efficient board meetings. So board meetings are the primary forum for governance, decision-making, and accountability. Effective meetings respect board members' time while enabling meaningful discussions and informed decisions. Clear agendas are a foundational tool, distinguishing between the information items and decision items and allocating the time appropriately for each. Providing materials in advance allows board members to review the reports, financial statements, and proposals before the meeting. So this preparation supports more focused discussions and reduces time spent on background explanations. Meetings should start and end on time, follow a defined structure, remain aligned with the governance priorities rather than operational details. It can get easy to be bogged down, again, getting into the weeds. Leadership plays a critical role in effective meetings. The board chair or president is responsible for facilitating the discussions, ensuring that all voices are heard, summarizing key points, and clearly stating decisions. Committee reports should include clear recommendations rather than lengthy narratives, supporting an effective action. Additional practices such as consent agendas and periodic board education can further enhance meeting effectiveness. By designing meetings intentionally, boards reinforce engagement, accountability, and strategic focus. All right, as we conclude our presentation today, I want to highlight several resources that can help board members as they continue learning about nonprofit governance and fiduciary responsibilities. I encourage board members to view governance education as an ongoing responsibility rather than a one-time training event or a box that you just simply check. The nonprofit environment continues to evolve, and staying informed about governance best practices helps boards make better decisions, manage risk effectively, and strengthen public trust. The top resource here is a great guide that's specific to the state of Oregon about responsibilities of board members. It has a lot of great content. The second one here relates to more of the tax compliance piece of things. It's an IRS resource. And then lastly, Board Rules and Responsibilities on the Council of Nonprofits website has a lot of great tools. And I encourage you to check that out as well. In closing, I want to thank Carrie and Tyler for sharing their expertise. Really appreciate it. And also a big thank you to all of our attendees who chose to spend their valuable time with us this afternoon. We really do appreciate it. Also, please don't hesitate to reach out if you had any questions that popped up over the course of the presentation. We're here when you need us, and we are happy to help. Thank you again for your time, and have a great weekend, everyone.